Hey guys, Kyle here. Hey, want to talk to you today about the fancy accounting term EBITDA, right? You may hear this term when you're trying to value businesses, when you're looking at, hey, what's the difference between cash flow and EBITDA? So let me explain what this term really means. So it stands for earnings before interest, taxes, depreciation, and amortization. So I'm going to talk about each one of these and why it's added back to the bottom line. Interest is pretty simple. Hey, I got an SBA loan I'm paying interest on. Maybe I'm paying interest on some truck loans for my company. If a new buyer was to come in, they won't have those expenses. As I move to taxes, this isn't sales tax, right? This isn't the business expense tax. This is going to be taxes by state or the federal government. So taxes are always added back to the bottom line. As we get to depreciation, depreciation is another somewhat simple one. I've got some new equipment. I'm going to use trucks again. I bought a brand new truck. I can depreciate that truck. That is a non-cash expense. So while I might be putting it on my taxes to lower my taxable income, this is what we call a non-cash expense. Very similar with amortization. Amortization, a good example of that would be, I'm a landscaping company. I bought another landscaping company. I can take and that goodwill that I bought, I can depreciate, or I can take some amortization, because it's not an actual asset. I can take some amortization and put that against my taxable income. Right now, EBITDA, again, is very much an accounting term. When we start talking about small businesses and how they're valued, it's much more off of their seller discretionary earnings, which I'm going to make another video about. Hopefully this gives you guys some insights, and thanks again for watching.